Hello and welcome to the weekly commodity market update. I'm Brownfield anchor Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Happy Tuesday, Will.
Yeah, happy Tuesday indeed. So we have some interesting things to talk about coming up in the show. But before we really get into the nitty gritty, talking about supply chains, what did we see adjust in the past week?
Absolutely. So looking at that old crop corn for May, up 14 cents to $7.64. New crop corn was up 19 cents. Old crop soybeans for May up 53 cents to 16.55. New crop soybeans up 46 cents to 14.85. Looking at those different components, soybean oil was up 2 cents per pound, soybean meal up $4 per short ton. And then the wheat contract, old crop wheat up 71 cents to $10.81. And new crop July wheat up 79 cents to $10.89. So overall, a rising week for commodity prices.
What kind of highlights did we see that carried us there? We saw things like that large sale to China on the corn front. What else did we see?
Sure did. We saw that early in the week, and we got another one this week, another million metric ton sale of U.S. corn to China. Probably what's most interesting about that, and I'm sure we'll talk about this more too, is substantial size for both of those purchases being for old crop corn, signaling for this summer. A lot of the highlights that led last week were really at the end of the week on Friday, as we got USDA supply and demand estimates last Friday. Everything largely came in as expected for corn, soybeans, and wheat, but yet we saw the markets rally pretty significantly. Highlights included decreased corn used for feed, down 25 million bushels, but increasing corn used for ethanol, 25 million bushels. So zero net change there on ending stocks. Global corn stocks increased on larger production in South America, primarily Brazil's second safrinha crop, and the European Union. U.S. old crop soybean exports were increased 25 million bushels on strong export sales and inspections to date, and then production changes around the world. Probably one of the bigger bullish signals out of last week's report was U.S. soybean oil exports. Despite record prices for all vegetable oils across the board, the demand for the product continues at home and abroad. U.S. ethanol production was down 33,000 barrels per day last week. However, output continues to remain strong. New export sales were largely down week over week. Corn was the lone commodity with higher export sales last week than the week before, largely led by that purchase that you mentioned. Weekly grain export inspections were mixed, higher week over week for sorghum and wheat, but weaker for corn and sorghum. Managed money was, again, back in the market building long positions. The positions for corn and soybeans offset some liquidation in the wheat positions. And then this week's crop progress report showed basically some minor changes to planting progress. Really, the planters are still in the barns there. And then some offsetting wheat conditions in the conditions report that basically kept wheat unchanged on the week.
So a lot to digest there, but like I teased earlier, today we're really talking about supply chains, where we sit now as to compare to near the start of the pandemic, and maybe what the outlook could look like. So first, we're sitting here still fairly early in 2022, just getting ready to hit planting season. So what's the supply chain outlook on things that farmers maybe, we've already gotten through fertilizer things, that ship is starting to sail as we do get into planting season. So where do we sit looking at the supply chain?
Yeah, great question. So I truly believe that the black swan, if you will, and again, black swans are defined as things that we can't predict. If we want to identify a black swan that's really impacted us at the end of 2021 and into 2022, and if I can foreshadow here, something that I think is going to continue to be a large issue as we move throughout 2022 and likely into 2023, is this whole issue of logistics. And I think, as we think about moving product, both from producer to end user, but also internally. So think of like companies trading with themselves for vegetable oil products, a crush facility sending vegetable oil, whether that be soybean oil or corn oil, to a food producer. I think all of those are going to be challenged and stretched in the year ahead. Give you a couple of examples. Some of our freight rates, as we think about dollars used to move product, are at some of their highest levels now compared to what we see in the fall when we've got a lot of product coming out of harvest that we have to move, especially in the soybean complex. So we tend to see a little bit of a relief this time of year and kind of get things lined up and worked out for that mad rush in the harvest season. We're not seeing that. We're not seeing any relief. And as we look ahead to the next couple of months, things continue to be projected tight as we think about logistics. So certainly, I think companies are going to have to manage this, but I think producers are also going to have to manage this and think about ways that they insulate their business from supply chain shock. So my short answer, Will, is the condition's not great. We've been dealing with this for months. The outlook is maybe as bleak, if not even bleaker than what we're currently dealing with.
So looking at the current situation, you said that a lot of the time during this time of year, we get some relief to the supply chain, but is it really just that the supply chain is so backed up that we're trying to play catch up and we're still just not able to do so?
Yeah, so it does come in a couple of folds. This is where economics become really enjoyable for me, is because price is a language. It's just like French or Spanish. It tells us a lot of things about what's happening out there, but understanding what's driving price is equally as important. So yes, we do have strong demand for products. I've mentioned that. I think at every outlook meeting I have given this spring is that strong demand in the face of higher prices has continued. And if you're a producer of a product, that's a very good sign. If you're a end user of these commodities, you're maybe not as excited about that outlook. But certainly, in the face of high prices, we continue to see strong demand. So that's one component of the price. The second component is availability of shipping, or I'm going to call them vessels. Let's just call it that. Vessels, whatever vehicle or vessel that the product is moving on, whether that be rail cars, whether that be trucks, whether that be ocean freight containers, right? Whatever those are, we continue to be in extremely short supply of all of those products. Labor is extremely tight, especially as we think about truckers. And that continues to be an issue. But then for like rail cars and barges, one of the things that I think has been interesting on that side is we had no incentive for about, and I say we, I'm talking about, let's just say grain transportation companies, people that are trading grain with each other, and they maybe own their fleet, their vehicle fleet, whether that be barges or shipping crates. There has been no incentive to build or replace shipping crates, barges, or rail cars for like 10 years. So we were dealing with a outdated system. And as a result, we didn't build or replace any of those. Then when steel prices went through the roof, there was every incentive to scrap those barges and rail cars for scrap metal. And now to try to replace that with steel prices where they're at, many companies just don't see a long-term return on investment to buy new rail cars and barges. So we've got a lack of vessels out there, vehicles, whatever you want to call them. And that's continuing to put a pinch or a bottleneck in our supply chains.
Really looking at the United States supply chain, especially. So a lot of this is just-in-time delivery, and that's the method that's really been used for quite a while. That's the type of delivery that when you look at maybe a macroeconomic scale on the most efficient way to run things and price effective, that has been the way to do business. But when you hear anecdotal stories like there's been cases of green beans that can't hit the grocery store because they can't get the shipment of the label, the product's ready, but the labeling isn't. So with all the clog ups and the issues that we've had, is really a just-in-time type of shipping supply still feasible, and is it still, if it is it still the best method that we have?
Yeah, great question. So there are economic benefits to a just-in-time system. Let's not overlook that. Storage is costly. It's an inventory cost, and inventory costs are expensive. So let's not overlook that. But what we're trying to do is we're trying to minimize those inventory costs while maximizing flexibility, right? I think that's what companies are trying to do now. It is interesting that probably all the consultants for the last 3 decades that have built this just-in-time system and made all the money building that just-in-time system are probably going to make a lot of money reversing and scaling back the just-in-time system. That's not a complaint. It's just a change of consumer, you and I's perception of what should happen, right? And should being a value judgment. For a long time, with no black swans, no issues, we wanted the cheapest product possible, and the just-in-time system provided for that. We're now maybe saying we're willing to pay a little bit more to ensure that the product's always there when we want it. And I think that's an important clarification here is we as a society have changed our values when it comes to availability.
So you attended, or at least got to listen to a forum that went on here recently talking about shipping costs and really the fluidity of especially shipping by rail, saying that it's going to get worse before it gets better. Does trying to change from the just-in-time method play a role in that, or what are the reasons behind that?
Yeah, so we did. We had the opportunity to present and attend the International Transportation Research Forum. It was held in St. Louis this year, which I learned a new term that St. Louis is branded the Ag Coast of America. I thought that was a pretty creative brand for the Port of St. Louis and for our region at large. But yeah, we had all the major grain and logistics companies there and presenting at different parts, and certainly a lot of academic researchers presenting as well. And the talk was all about, as you would expect, the challenges we've had in all areas of transportation, not just ag, but even in goods and services. I found it interesting. One of the companies specifically to ag mentioned that they're giving discounts on their product to their end users as long as they use the money saved from those discounts to build storage. So back to our comment there about, are we switching from the just-in-time model? That's telling me that all parties seem to be interested in moving away from the just-in-time system. And the reason that this particular company was interested in offering discounts on their product. So again, they're selling a product and they're offering discounts on their product as long as the end user uses it to build storage, was because they're like, they need product on a Monday, but we can't get it there till a Friday. And so we need some flexibility in terms of our delivery. And the reason we need flexibility on delivery is because we can't get rail cars. And I thought that was a really interesting point and probably one of the highlighting statements of the entire conference.
Tell me if I'm comparing apples to oranges here, but we've seen in things like meat processing, there'd be a push to open up smaller processors to try and alleviate some of the issues that we had, just whenever the big one shut down, couldn't get that through the market. Are we seeing some similarities within just the actual shipping business itself? Maybe some new businesses coming online, maybe smaller, different routes for shipping a lot of these products?
I do. I really do. I think St. Louis being branded as the Ag Coast of America is coming with the legs under it that they also expect to see a large increase in containers, containers carrying ag products, containers carrying all goods that are, instead of coming through Long Beach or Oakland, they're coming through St. Louis and getting on rails or trucks here in the Midwest to help move products. So I do think we are seeing some interesting innovation at different ports, maybe more inland than what we would normally expect.
All right. Do you have any final thoughts you might want to add? Anything that a lot of end users might expect over in the next couple of years?
Well, in general, I do think actually we've got a major issue when it comes to transportation. It is not necessarily a consolidation issue. Certainly that might have without any evidence, I can't say whether it is or is not. I can say that it is bigger than just consolidation if that is a problem. And we're going to have to deal with this across the spectrum in all goods, including grains, as we move ahead.
All right, Ben, it's always a pleasure. Reports to watch for those of you who want to watch some market adjustments maybe. We have the ethanol report that comes out on Wednesday. Thursday, we have export sales. And then on Black Friday, we have the NOPA report, so some things to watch for oilseeds. As always, thank you, Ben, for joining me. I'm Will Robinson on Brownfield.